Welcome back to Real Estate Economics Weekly webinar series covering this week the Fresno, California market area. This is part 4 of 4, so please view the previous part so that you can understand the material we've built on to this point. This particular slide shows housing demand and supply. Shown in blue is the supply of housing, which we've mentioned earlier in our discussion of permits, tends to grow quite slowly over time. That's true throughout the state. It takes a long time to buy land, design product, build it and sell it. So housing supply is a really slow-moving, low-oscillating number from year to year. By comparison, the demand changes quite a bit. You can see the pronounced seasonal factors in this particular market area, but there's also longer-term trends. When the employment market becomes stronger and more robust, demand can surge quite rapidly, and supply is very rarely able to follow. The only way for that to manifest itself is through higher prices. If you take strong employment and higher demand and couple that with substandard underwriting and lending conditions, you have a real recipe for problems, as we've seen the past few years. Coming out to about 2009 in this particular graph, you can see a real trail off in demand. That's our current recession or recently completed recession and ongoing economic disruption. You can see that the demand for housing is going to grow fairly slowly over the forecast period. And this ties back to our previous discussion on employment, where the job base has not been growing that rapidly in this market area. Supply tapers off a little bit, and gradually towards the end of the forecast period, these two indicators will sync themselves back up. In terms of valuation, when employment is robust, there's higher supportable median home prices because incomes tend to ratchet up a little bit. In historical prices, have traditionally been the relationship between incomes and what people could afford through the loan qualification process. So people could afford a little bit more gradually over the years as interest rates have declined. Now this particular market had a disconnect in the late 90s that turned out to be fairly sizable, and then that synced back up just in time for the subprime. You can see that with the big shark fin at the top right center of the screen. At that point in time, the price of the home that people could buy became completely disconnected from their household incomes through the subprime mechanism. So, as we mentioned, that manifests itself through much higher prices, unsustainable as we know. Come forward to January 2009, and you can see where the green line goes straight up. That essentially mirrors the decrease in interest rates from 6% to 5% when the government intervened in the mortgage market. That allows the local household income to afford a much larger house. They just don't do that right now because of confidence issues, lack of security in employment, and perceived significant overvaluation. In fact, it's undervaluation, and people will gradually recognize that over time, and these lines will sync up again over the forecast period. Here's price trends for this particular market area on a median basis, annual numbers. So if you recall earlier in our presentation, we had some much higher numbers on average for a single month, but these are full year prices. Go to 2010, where our current median price annualized is $163,630. That really puts us back between 2003 and 2004 if you cut out the subprime era. If you look across the West and regionally, we've been able to see that the most impacted markets are now returning to 2001, 2002 prices. Markets with much stronger employment and other locational features have only given up prices back to 2004, maybe 2005 or 2006. Here's annualized price change. You could see with a few exceptions the 90s were relatively tame, but then we had huge price appreciation in the mid-2000s, again corresponding with our subprime issues, and now we've entered the give-back period on this. On a median basis, the full price change over these 4 years from 2007 to 2010 is pretty much up on 50%, with some modest appreciation over the forecast period. That modest appreciation over the forecast period is really remedying the undervaluation that's taken place as a result of steady household incomes and lower interest rates. It's not really a function of huge economic improvement or some great turnaround in employment. You can see that here in our residential market opportunity risk report for 2000 to 2014. On the left-hand side, we have housing demand. Again, that's correlating quite well with employment. So when jobs are available and the employment market is robust, housing demand surges. And it also retrenches just as quickly. Housing supply, as we've mentioned, grows very steadily. And in a situation like we have now, there are essentially too many houses for the size of our currently diminished job force. The recession's pushed enough people out of the market that the housing stock is essentially too large for our labor force, and the market is characterized as overbuilt. Look at the median home price. You can see the trends that have taken place there. We've come back off with those same annual price changes we addressed in the last slide, and again we've got some appreciation going forward. If you come to the center of the screen with the equilibrium home price, you can see that stays almost steady from 2009 through the forecast period. Now that's a result of slightly increasing interest rates offsetting slowly growing wages. So that keeps the equilibrium home price about the same, and gradually the market will remedy its current undervaluation and will reach a condition of equilibrium at about 2013 or 2014. Gradually people are recognizing this undervaluation, and there's a lot of ways we can see that on the ground. There's parents helping their kids buy houses, there's abundant activity by rental investors and people who've been through this before. They can see that the market's undervalued and they're active, whereas a lot of people, younger people who don't have a lot of experience on the housing market side, don't really have the perspective for it. On the far right side, we use these indicators to predict market health in 24 months. So if you go to 2008, we're showing a green reading of stable. Now that applies to the market for 2010. So during the course of 2010, the overbuilt condition reaches its peak. Undervaluation is very significant and will gradually lead to a stabilization. We've seen that somewhat in prices now. We still have quite a bit of distressed inventory we have to work through, but we've already talked to how it looks like there's very little pressure on interest rates. We are a little bit concerned about incomes. Household incomes tend to grow slowly at times. They don't go backwards too often, but disposable incomes may be a problem here. We've got a big income tax increase coming at the end of 2010 and a lot of other government actions that may cost us money, so how much people will have left to spend on a house remains to be seen. A couple of quick conclusions. Employment growth has really been stunted here in the last year or two, but it's been lackluster for a decade. That's true across much of California. We've got an environment where a lot of businesses are preferring to locate in other places or keep their operations small, and that's kept our employment really substandard for not just a year or two, but going back for quite some time. We don't believe foreclosed homes will meet demand, particularly from owner-occupants. There's a lot of reasons to be in new construction. If you move into an existing neighborhood, you don't know who's about to get flushed out, who's in foreclosure, who's delinquent on their loans, and values could continue to erode under your feet. We don't think that happens as readily in a new home subdivision. A lot of rental demand will go to the single-family market. Many buyers will prefer to remain mobile just for employment reasons, and mature buyers, we like this area for mature buyers, but a lot of mature buyers are going to be wary about California due to our financial outlook. Here's an overview of what we do at Real Estate Economics. We do residential market consulting, site-specific feasibility studies, either on a site-specific or case-by-case basis or on a retainer basis. We do quite a bit of supply and demand, price forecasting, appreciation, and trending. On our online or website side, housing transactions report, those are the maps we showed in part 1. We do a lot of field surveying, which is in our new home profiles, and residential economic reports. Here's our team. Many of you know Mark. I'm John. Judy and Sandy in sales. Thank you very much for joining us today.